Hello everyone, this is going to be the first in a series of videos covering my most recent research report on Secure Trust Bank. Um, just to, as a bit of preamble, and just reference, you can find this full report over on firmreturns.com. You can see here up at the top. Um, it's on the latest issue page on the front at the moment, but in case you're arriving at this later, it's also can be found under the research reports. Um, the full report is what we're going to go through, but it's about 16,000 words. So realistically, I'm going to have to break it down into multiple videos. I even it might end up with each video still being 1 to 2 hours long anyway. Um, but yeah, and in terms of what you can actually see for free, if you're not a paid subscriber, it will be basically what we're covering today in this video, and then the following videos will be covering what you'd have to be a paid subscriber to see. So definitely worth checking those out if it's of interest. So with no further ado, let's start going through. So Secure Trust Bank is a specialist lender listed on the main market of the London Stock Exchange with a market capitalization of £152.6 million at time of writing. I think it might be slightly higher than that now, but still pretty much around that ballpark. It currently trades on a 5-year average earnings multiple of 5.1x and a price to tangible book value of 0.45x. There is also a strong case for an upward inflection that would bring these down further to 2.6x and 0.4x within the next couple of years. We'll get into all of that in due course. So I just I'll start off with a bit of an executive summary um, here, which I've done, which should give you a quick intro. Then some history on the company, and then a bit of an overview. And basically, most of this episode is going to be going through the retail finance segment, which forms the first section of the report. Yeah, let's just quickly go through the executive summary so you get a bit of a better picture of the pitch here. So as a bank, STB is in the business of lending and does so today through four key segments: retail finance, vehicle finance, real estate finance, and commercial finance. The first two falling under consumer finance and the latter two under business finance. All four have seen lending growth over the last 5 years, but faster growth from the consumer finance segments has resulted in them increasing their share of lending from 45.5% in 2019 to 51% in 2023. I think it might have crept up a little bit more as well because in the interim results, which I won't go over in this video, they'll be once I've done this series on this full report. I also did a company update covering the interim results, so I'll go through those then. But I think the share has now crept up a little bit higher because they had the retail finance segment has continued to continue to grow even in the current economic environment, whereas some of the business finance sides have been languishing a little bit. Real estate finance and the commercial finance businesses in those sectors are struggling a bit, which is holding down the losses are minimal because of those in the business finance segment, as we'll get onto, they're secured by assets, but which you don't really have so much you don't have in the retail finance side of things. But the actual growth of the overall portfolio is kind of say it's fairly flat, just to mild growth this year, whereas we're still growing quite rapidly with the retail finance. But anyway, so this change in the share of lending has coincided with the strategic shift in retail finance towards interest-free lending, which now makes up 86% of the segment's loan book. The current CEO and CFO, assuming their roles in January 2021 and September 2020, respectively, have led a drive to focus the company on its core business segments, divesting a number of non-core segments in the process. They deem the business to currently be subscale and are aiming to grow the loan book to circa £4 billion. It's, I think, around about 3.3 at the moment. But we'll get onto that in a later episode, I think. But yeah, that's just to give you a quick benchmark of where we are at the moment. At which level they expect to be able to generate a return on average equity of 14 to 16%, a net interest margin of greater than 5.5%, and a cost income ratio of 44 to 46%, while maintaining a CET1 ratio above 12%. CET is Common Equity Tier 1, so it's effectively just the proportion of assets that are I can't remember the exact definition actually. I think it revolves around the proportion of funding that's provided that constitutes common equity as opposed to customer deposits. Management are incentivized to achieve these targets by the end of 2026 as they form the vesting criteria for their LTIP share awards, long-term incentive plan awards. Based on a share price of £8 per share and a corresponding market capitalization of circa £152.6 million, STB currently trades at a price to 5-year earnings multiple of 5.1x and a tangible book value multiple of 0.45x. Using the midterm targets outlined above, the forward price to earnings multiple becomes 2.6x and the price to book value multiple 0.4x. That's what I had in the little abstract at the top as well. And to give you a reference, I think it's £8 a share I said there. I think it's about £1.10 a share at the moment, something like that. So yeah, it's just slightly up on where it was, but still trading comfortably below 0.5x. Is it comfortably below half of the actual book value if they were to liquidate the company? Well, cash in all that, let all the loans pay and don't issue any new loans, and use it just repay all the deposits, then they'd be left with you'd effectively double your money at this point. I'm sure there'd be some frictional costs associated with that, but still, yeah, it's trading for a lot more than it's worth. Sorry, a lot less than it's worth. And finally, with a 25% payout from the company's progressive dividend policy, the dividend yield at this level of earnings would be 9.4%. So yeah, just on their 25% payout, which, to be honest, once they get to scale, I think they could quite easily put it up to 50% payout, which is various points in the history they have done. So if they did that, then you'd be looking at close to a 20% dividend yield based on the current share price if they hit these midterm targets. Right. Anyway, so let's just have a quick look through some of the company's history. So it took quite a bit of digging through all sorts of filings with the Companies House, which is the UK government's department for company records and so on, to go and jump around and try and trace back the history for the company and the various kind of ownership it's had. And it's gone through a few different cycles of structures and stuff as well. So let's just have a look through some of that. So the company's early history is a little patchy, as it spent several decades in private ownership before becoming public. But what I can say concretely is that it was incorporated in 1954 as Secure Homes Limited. For at least some part of the subsequent 30 years, it was owned by the Dow Chemical Company before being sold in 1985 to what is known today as Arbuthnot Banking Group. I'm not quite sure whether I'm getting the pronunciation of that name right, but let's just go with Arbuthnot. At the time, uh, yeah, well, okay, sorry, I'm going to get into that in a second. So at the time, it formed the core asset of a newly incorporated holding company called Secured Homes Trust Limited that changed its name to Secure Trust Group PLC in 1988 when it became a public company, before changing it again in 1998 to Secure Trust Banking Group PLC. And finally, Arbuthnot Banking Group in 2005 when the holding company was admitted to the alternative investment market, also known as AIM. The Arbuthnot name refers to a private and merchant banking group brought into the holding company that traces its origins back to the 1800s. In 1994, while within the holding company, Secure Homes Limited re-registered as a public company and it changed its name to Secure Trust Bank PLC. It then had its own IPO on the AIM market in 2011, with Arbuthnot Banking Group retaining 75.5% of the company. They continued to hold majority control until 2016, when they sold down their position to 18.64% as STB moved from AIM to the main market. And today they don't appear on the substantial shareholders list at all, which means that their stake is either completely gone or certainly below, I think, 3%. So, yeah, as I mentioned before, the company has four. We're just doing a bit of a quick company overview here. So, as mentioned in the executive summary, it has four segments: retail finance, vehicle finance, real estate finance, and commercial finance, with a division between consumer finance, which is retail finance and vehicle finance fall under, and business finance, which real estate and commercial finance fall under. So in prior years, it also had a number of other operating segments, the most recent of which were consumer mortgages and asset finance, both divested in 2021, and debt management divested in 2022. These divestments occurred under the tenure of the current CEO, who took over the role at the beginning of 2021 as part of a strategy to focus the company on its core business lines and grow net lending balances. Right, so let's start going into the meat of this episode, which is going to be looking at the retail finance segment, which I believe now is the largest segment in the business. It's certainly the most rapidly growing. So yeah, let's just have a quick overview of this, and we'll start getting into some of the details and some analysis of that growth later on. So STB provides retail finance through the V12 Retail Finance brand, which it acquired along with the rest of V12 Group Finance Limited, V12, in 2013. The details of the transaction are quite interesting, so I'll detour briefly to discuss them. V12 had developed a proprietary technology platform designed to be integrated into retailers' checkouts to enable them to offer point-of-sale loans to their customers, both online and in-store. Through these integrations, it had managed to build up a loan book worth £32.7 million, but due to its lack of a banking license, had financed this almost entirely using wholesale debt, circa £7 million in subordinated debt and circa £28.5 million in bank loans. This is a problem many fintech businesses face. An inability to access retail deposits means they have to rely on wholesale funding, which is considerably more expensive and makes profitable growth challenging. It is therefore a natural fit for them to merge with a licensed bank able to raise funds from retail deposits. The alternative would be to pass the loan financing to a third party and simply charge a fee for use of the point-of-sale technology platform. So we're going to go into some detail on some competitor analysis at the end of this video. And in there, we'll see some examples of companies who are struggling because they are still reliant on wholesale funding, and especially with interest rates rising. And we'll see other examples of where they have been merged into or acquired by another bank. And we'll also see examples of where they've kind of passed the actual loan financing off to a third party and are just providing the point of sale technology platform. So in addition to the £3.5 million in cash consideration to the equity holders, STB agreed to repay the existing debt on completion of the deal, thus clearing the more expensive wholesale liabilities of the company. This was partly financed from the proceeds of a £20 million share placing conducted in November 2012, which also highlights the benefit for V12 of merging with a listed company, access to the public equity markets being the benefit. From STB's standpoint, the company gained a point of sale technology platform, new retailer relationships, and a £32.7 million loan book equating to around 50% of its existing retail finance business at the time. The management of V12, including CEO Nick Davies, stayed on to run the business after it joined STB and have helped to grow the loan book to £1.22 billion as of 31st of December 2023. I should note that Nick Davies recently stated his intention to retire after running V12 for more than 2 decades. And I believe it's an internal promotion that's now taken over to replace him, a guy who'd been running running the sales side of the or the business development side maybe, of the business that's now taken over the overall management of the retail finance business. But again, I think a guy who'd been with the working with the company for a long time. As I've mentioned, the point of sale technology platform several times now. Let's discuss it in some more detail. From an integration perspective, V12 is very similar to the other payment processors, e.g. PayPal, Stripe, etc. The customer is able to select V12 Finance as a payment option during checkout, at which point they're redirected to the V12 Finance website to complete their application. Filling out the required fields generally only takes a few minutes, and then an automated loan decision is made, taking less than 6 seconds in 90% of cases. If the application is successful, the customer is provided with a contract to sign electronically, and then the retailer is notified so they can process the order. Once the product/service has been delivered, the funds are released to the retailer, minus a charge if the finance is interest-free. V12 then charges the customer on a monthly basis until the loan has been repaid. The customer is able to manage their loan through a self-service portal where they can, amongst other things, view their outstanding loan balance, see their payment history, and send a secure message to V12 customer support. When a customer has an account with V12 Finance, their details can be reused across all future loan applications with any supported retailer, of which there are currently 1,400 across the UK. I think that's since risen with some fairly new retailers, some fairly new large retailers added in the last 6 months or so. Speeding up and simplifying the application process for the customer. The in-store process is much the same, with the customer being able to fill out the electronic application form, receive a loan decision, and sign the contract there and then. So let's have a look at some of the finance types. So V12 gives retailers 3 types of finance to offer their customers: interest-free, interest-bearing, and deferred payment credit, aka buy now, pay later. Interest-free. Standard terms from 3 to 60 months. Interest-free loans of 12 months or less are unregulated and so do not require the retailer to obtain FCA, aka Financial Conduct Authority, authorization. So yeah, in the cases where a retailer wants to offer their customers larger loans with a longer duration than 12 months, they need to get a authorization from the FCA. But if they just wanted to offer them interest-free loans of 12 months or less, they don't at the moment. That potentially might be changing. I've heard some chatter about some new regulations coming in around, well, not so much around interest-free, but around sort of shorter term duration stuff with buy now, pay later being the focus. But we'll get onto buy now, pay later with deferred payment credit in a bit. So purchase sizes for the interest-free typically range between £100 and £50,000, and repayments are made monthly with an optional initial deposit. For the interest bearing, the standard terms go from 12 to 18 months, so they don't offer any shorter term ones for interest bearing. It's not worth the hassle, I don't think. And the purchase sizes range between £250 and £250 and £50,000. Now, this in the interest bearing is regulated, meaning that the retailer must have FCA authorization. And the annual percentage rates, APRs, range from 4.9 to 19.9%. Interest and principal repayments are made monthly with an optional deposit. And finally, the deferred payment credit has a standard term of 60 months. Oh, sorry, of standard terms up to 60 months. So the same as the interest-free. And the purchase sizes range between £250 and £15,000. It is regulated and therefore requires the retailer to have FCA authorization. Yeah, so I don't know whether the interest-free stuff, as long as it's not deferred payment credit, I think the interest-free stuff potentially still doesn't require authorization up to 12 months, and that there might not be chatter that's going to change. It was actually the regulations around the deferred payment credit that are looking likely to change. But yeah, that's still a few years out. Yeah, and the APRs on deferred payment credit start from 9.9%. But I think generally with these things, you only start paying that interest if you don't repay it on the in full on the required payment date, or the date of the first repayment. Because the first payment can be deferred for 6, 9, or 12 months. Customers can repay their loan in part or in full, free of interest during their deferred payment term, and after that point, the loan operates like a regular interest-bearing loan. Yep, there you go. So following the acquisition in 2022 of AppToPay Limited for £1 million, V12 has begun piloting a new shorter-term Pay in 3 product with a selection of 27 retailers. As it currently stands, this requires customers to download the AppToPay app and pre-apply for a credit limit. When making a purchase of between £100 to £500 with one of the supported retailers, they will then be given a code to enter into the app, at which point the purchase will be charged against their pre-agreed credit. The customer will then repay the loan in 3 equal monthly installments starting 30 days from the date of purchase. So you can just see an example of one retailer, which is Scottsdale Golf.co.uk, their website, showing you an example of AppToPay being offered as a payment method in here, alongside also V12, PayPal Credit, Klarna, and yeah, those four. See, I've downloaded the app myself and found the process to be a little clunky compared to the pay in three offerings of their competitors, e.g. Klarna and PayPal. First of all, you have to download the app and pre-apply for credit before you can make a purchase. You can't fill out the applications, let's register your details during the checkout process like you can with Klarna, PayPal, or regular V12 finance. Secondly, the payment does not feel particularly well integrated into the checkout process, being given a code and then having to navigate away to a separate app, which requires a multi-step login process, unlike most banking apps, is very clunky, especially if you're making the purchase on your mobile. You don't then get automatically returned to the retailer's website like most people have come to intuitively expect. While there's an argument to be made that STB will be able to may be able to leverage its existing relationships with retailers, the fact customers need to have downloaded the app and pre-applied for credit makes it quite unlikely anyone will choose AppToPay over its better-known competitors. To change this would require a substantial investment in direct-to-consumer marketing, which has so far not been needed with V12. I have raised these points with management, and they said they have received similar feedback from other trial users. They're currently looking at ways to make the first credit application as seamless as V12, and judging by their experience with adoption of the self-service web portal, they expect a good proportion of users to download the app without making it mandatory. It also sounds like they plan to integrate AppToPay into V12 so users can manage longer-term loan applications through the same app. This will additionally provide some immediate brand recognition, which will help with consumer marketing. Other features like a virtual card for in-store payments rather than a PIN are also being considered, but will likely come later. It certainly seems like management have a handle on things and have taken away some good lessons from the pilot. We'll have to see where they go from here, but there's a lot for them to go after. The higher value products which V12 currently finances only make up around 20% of retailers' sales volumes, meaning the addition of a shorter term buy now, pay later product will allow the company to compete for the other 80%, an area historically served by credit cards before the introduction of interest-free alternatives. With an existing customer base of over 840,000, V12 also has a pretty good platform from which to launch a direct marketing campaign. So we've seen some progress on this in their interim results. They announced that they were going to be doing what they suggested, which was kind of making the AppToPay app. They might be rebranding it effectively the app for V12 finance. So it will also allow customers to manage all their V12 finance applications as well in there. And then it will still obviously have they're going to improve the existing features in there and have it so it can you can make these shorter term applications what do they do? They describe it as first credit application. Yeah. So when this is the first time you've done it and you're not already in the system, making it as seamless as V12 currently is. So yeah, all the signs are that they are moving this prototype in the right direction, given the feedback they've received. So then move on now to have a look at how V12 selects its retail partners. So one of the principal strengths of V12 Finance that gives it some defense against competitors stealing market share is the relationship it has built with retailers. These relationships are actively initiated and maintained by a strong business-to-business sales team, that selects new retail partners according to the following criteria: annual sales turnover of at least £1.5 million, at least 24 months of trading history with audited accounts, must be profitable, and it must sell products or services to consumers rather than businesses. And in the cases where the product they're wanting to offer requires they must have FCA authorization. These selection criteria encompass a wide range of retailers across many different sectors. And here are some examples. So within furniture, they've got Dreams, Oak Furniture Land, SCS, DFS, and Sofology. Within sporting goods, American Golf, Ribble, Giant, Outdoor World. Season tickets, which is so football season tickets, which is a newer product line they've started offering. Include Arsenal, Manchester United, and West Ham United. In jewelry, they have partnerships with Watches of Switzerland Group, which includes the brands Watches of Switzerland, Mappin and Webb, Goldsmiths, Goldsmiths and Mayors. And separately, they've also got relationships with Beaver Brooks and W. Hammond. But obviously, they've got over 1,400 retail partners, so this is just a small selection. They focus on the sectors where customers have higher credit quality, which tends to be higher value items such as furniture and jewelry. Electricals is one sector they have particularly avoided due to its association with low credit quality customers. So now let's have a look through some of the customer ratings for the V12 Finance brand. So V12 Finance has an excellent reputation with customers, demonstrated through very high ratings on independent review sites. This includes 4.9 out of 5 stars from 15,602 reviews on Trustpilot, 4.8 out of 5 stars from 4,949 reviews on FIFO. So you can see here. So yeah, got a great reputation with customers, a strong brand already. So yeah, it's a great asset within the business. So now let's have a look at some of the financials. So we'll have a look at the loan book growth first. So as you can see here on this graph, STB's retail finance loan book, net of impairment provisions, has grown from £452.3 million in 2017 to £1,223.2 million in 2023, equating to a compound annual growth rate, or CAGR, of 18.04%. New business volumes have been very similar over this period, demonstrating the relatively short duration of the loans being issued. As you can see from the graph above, growth was very linear from 2017 to 2019, then stumbled for a couple of years during the pandemic before rebounding in 2022 and 2023. So you can see this on the graph here, just a little dip, but pretty much the actual trajectory almost resumed the growth we've seen before. And because of the shorter duration, of the loans being issued, as I mentioned, new business volumes and the closing loan book were pretty comparable in each year. Now, you see when we go on to some of the other segments where they have longer duration loans, there's a much more variation between new business volumes and the closing loan book value. In some cases, the new business volumes are higher. In other, because they're replacing all the existing loan book and adding more. In other cases, it's still the way around and so on. So yeah, we'll get onto that shortly. Well, it'll actually be in the next video. But yeah, so let's move on to the net interest income and the risk adjusted income. So over the same period, net interest income grew from 41.1 million pounds to 73.1 million pounds, equating to a slightly more muted CAGR of 10.02%. This is due to decreasing margins offsetting the loan book growth. So you can also see the net interest margin coming down here as well. And quite a lot of this is to do with the fact that they shifted uh, towards the interest-free and lower risk stuff, which also reflected in the closing margin between, as we'll mention in a second, between net interest margin and risk-adjusted margin, which you can see sort of closing on this graph here. So the gap between net interest income and risk-adjusted income, which is net interest income plus net fee and commission income plus slash minus gains slash losses on modification of financial assets minus the net impairment charge. So this gap between the net interest income and risk-adjusted income was significantly wider in 2017 and 2018. This can be explained by the strategic shift made in 2019 to focus on interest-free credit, growing its share of the average loan book from 62% in 2019 to 85.7% in 2023, which you can see on this graph below. While interest-free credit is lower margin, the cost of risk associated with it is also generally lower. So the cost of risk is effectively your impairment charge. This is visible in the narrowing gap between net interest margin and risk-adjusted margin. The particularly small gap in 2021 is a pandemic anomaly. So yeah, we can see here an overall narrowing, but it narrowed excessively in 2021 just because of the effectively the government backing on consumers, which really reduced impairments. So in addition, there have, of course, been substantial interest rate rises in 2022 and 2023, applying downward pressure on margins due to a lag in and limit to passing them through to consumers. But obviously, depositors are still they still have to be competitive with their deposit rates. So those have continued to rise in line with the market, but there's only so far they can pass that on to consumers and not have volumes decline or defaults increase significantly as well. So interest rates have stopped rising, at least for now, and interest-free credit making it more than with interest rates having stopped rising, at least for now, and interest-free credit making up more than 85% of the loan book, it's likely net interest margin will stabilize around its current 6 to 7% level and potentially rise if the yield curve flattens. So long-term rates increasing to exceed short-term rates again, which is how it should be naturally. But at the moment, or in the last year or two, a couple of years, it's been inverted. We should therefore start to see net interest income / risk-adjusted income moving in tandem with loan book growth. So yeah, whatever the compound rate of the loan book is from now on, the net interest income should pretty much match it. So let's have a quick look at mention of market share, and before we go on to have a look at some of the competitors. So while the overall retail finance market in the UK is pretty well the same size today as it was 5 years ago, V12 has grown its share of new business from 8.2% in 2019 to 13.5% in 2023. Below, I'll take you through some of the competitive landscape so you can get an idea of the competitors they've taken this market share from. So actually, I think now, let Let me just jump up, have a look at the. I think it's actually the market share has jumped significantly since then, as they've continued to grow. So just in the first, um, yeah. So it's actually grown from 13.5% as of 31st of December 2023 to 30th of June. It's actually got up to 17%. So they're actually becoming one of the dominant players in the market. Um, but yeah, I'll look at that in more detail in a future episode. Look at those half year results. But let's have a look at the first competitor, which as you'll find out is not really that's kind of withdrawn from the market. But let's they were a fairly major player, and that's probably part of the reason why STB's share has gone up. There's some larger competitor like this leaving. So the first competitor though is Barclays Partner Finance. So Barclays Bank offers retail finance through the Barclays Partner Finance brand. Its product set pretty well matches V12s with interest-free, interest-bearing, and deferred payment credit, all offered omni-channel at point of sale. The sectors served also overlap with V12 as they include electrical, home improvement, furniture, sports and leisure, and jewelry. A couple of notable retail partner examples are Amazon, where Barclays Partner Finance provides interest-bearing credit, and the Apple Store, where Barclays, let's call it abbreviated BPF, where BPF provides interest-free credit. Obviously, those are two very large partners. At 31st of December 2023, BPF's loan book size was £2.3 billion, almost twice the size of V12's, but they have been actively pulling back from the market and decreasing partner numbers. This can be seen in the fact BPF's loan book was £2.6 billion at 31st of December 2022. So it's decreased. With Barclays' large retail deposit base, there's certainly no lack of funding, which facilitates it taking on such large partners as as Amazon and Apple. So for those that don't know, Barclays is like I think probably the one, if not the largest, uh, bank in the UK. So yeah, it's one of the banking giants here. Um, whereas so it's I mean it's gonna and obviously a lot of that is gonna be mortgage lending and what have you. Is that but it's bread and butter business lines. Um, but well, actually, Barclays is my main bank as well, and my wife's. So it's a very big one with lots of retail branches around the country as well. Um, yeah, so BPF also has a very low risk tolerance, as evidenced by the uh, FY23 cost of risk being just 0.7%, and probably as well the fact it's pulling back from the market at the current time. Unfortunately, however, this low tolerance of risk may have contributed to a terrible Trustpilot review score of 1.3 out of 5 stars from 552 reviews, many due to what was perceived to be unfair credit rejection. As STB avoids electricals, where Barclays has been most prominent and doesn't as yet have sufficient scale to compete as a sole provider for large retailers, it is unlikely that it stands to benefit greatly from Barclays' current withdrawal from the market, beyond just the fact that its percentage share will actually increase if until Barclays is replaced as a lender in these uh, areas. So yeah, I think from the sound of it, they're pretty much making a full withdrawal, so not offering any new things. I'm guessing they're winding down their existing relationships. Um, So for the time being, they're not really a competitor that STB needs to worry about. So next we have a look at Creation Consumer Finance Limited, which is actually a subsidiary of the French bank BNP Paribas, and specifically their personal finance subsidiary. It again offers a very similar product set to V12, with interest-free, interest-bearing, and deferred payment credit being offered omnichannel at point of sale. As you'd expect, with the backing of a large bank, Creation has secured a number of major retail partners where, like BPF, it is the sole finance provider. These include B&Q, Currys, M&S, John Lewis, Wren Kitchens, DFS, SCS, and Dreams. Not sure about those last. Yeah, it's not the sole provider for some of those because, as we know, STB also provides finance for SCS and Dreams. But I think it is the sole provider for B&Q, possibly Currys, M&S, and John Lewis. So yeah, some really big ones, really big retailers in the UK. In total, Creation has over 300 partners, though this includes car dealerships for which they provide vehicle finance. I don't have the company's 2023 figures, but as at the 31st of December 2022, it had gross loans and advances of £2.14 billion. While this includes vehicle finance and personal loans, I'd expect most of the total to consist of loans made to its retail finance partners. To give you some evidence to support this assumption. In 2018, when Creation initiated its partnership with Currys, it was estimated that credit provision would total £440 million in the first year. Aggregating the loan books of all the aforementioned large retailers is likely to make up the majority of the £2.14 billion total. Digging into the details a little further, 81% of loans and advances are due in more than 1 year, which implies they're for higher value items. The cost of risk recognised in 2022 was £69.1 million, equating to 3.3% of the gross loan book at the year end. Though again, this includes auto loans, which tend to be higher risk. Net interest income for the year was £179.7 million, which is calculated from £207 million in interest income minus £27.3 million in interest expense, giving a net interest margin of 8.4%. Remember, though, this is back in 2022, when the interest rates were quite a bit lower. And this also incorporates some of the vehicle finance, which is going to naturally have a higher interest rate than things like interest-free loans and so on, which the interest rate is calculated from the subsidy paid by the retailer. Adding other income from commissions, etc., and subtracting transaction and commission expense gives the operating income of £175.4 million. Subtracting the cost of risk gives us a risk-adjusted income of £106.3 million and risk-adjusted margin of 5%. Operating costs amounted to £82.9 million, making the cost-income ratio 47.3%, which is pretty good. We don't have an allocation of operating costs specific to STB's retail finance segment to allow for direct comparison, but Creation's cost-income ratio is significantly better than the aggregate STB group, as we'll see later on. Just for reference, STB's target for their midterm targets is, I think, about 44 to 46%, cost to income ratio. So it's kind of around the level that creation's already operating at. Subtracting the operating costs and cost of risk from the operating income gives us the profit before tax of £23.4 million. And after tax, the net profit is £18.8 million. Finally, creation has an excellent 4.7 out of 5.0 star rating from 59,617 reviews on Trustpilot. This reputation, combined with access to pretty well unlimited cheap funding from its parent, make creation a formidable competitor. So yeah, this is definitely going to be one of the dominant players in the space, and certainly one that V12 is going to and STB in general is going to have its work cut out competing against. Right. So next we have Novuna Consumer Finance, which is owned by Mitsubishi HC Capital UK PLC. It too has a product set that closely matches V12 with interest-free, interest-bearing, and deferred payment credit offered omni-channel at point of sale. Novuna's retail partners generally seem to be more mid-sized, much like those of V12. In total, it has partnered with over 3,000, including Arga, Optical Express, Carpetright, Brother, Purely Diamonds, Overclockers UK, Homebase, H. Samuel, Magnet, PC Specialist, and Treads. At 31st of March 2023, its loan book was £3.1 billion, slightly up on the prior year of £3 billion. But new business was flat at £2.3 billion. The reason for this is the company's reliance on wholesale funding, which has meant it's had to take a serious hit to margins just to maintain volumes. I would expect the impact to have worsened in FY24 as interest rates have continued to rise. Net interest income for the year was £104.3 million, calculated from £171.8 million in interest income, subtract £67.5 million in interest expense, giving a net interest margin of 3.4%. So much lower than creation was doing there. And Securitas Bank as well. It's about half of the net interest margin Securitas Bank has because of that cost of the wholesale funding. So adding other income from commissions, etc., and subtracting other costs of sales gives the operating income of £101.8 million. Let's just yeah, I mean that is substantially, again, we have got to factor in that the creation had the vehicle finance bundled in with it, but still, considering they had a lower loan book and their operating income was significantly higher, 175.4 versus 101.8 for Novuna. So yeah, the cost of risk recognized in FY23 was £15.7 million, equating to just 0.5% of the loan book. So very good. But subtracting this from the operating income gives the risk-adjusted income of £86.1 million and risk-adjusted margin of 2.8%. So yeah, really getting low. Still profitable, but barely. And then we then subtract operating costs of which amounted to 73.5%, which here makes the cost income ratio 72.2%. So really not good. This compares Yeah, I say here, this compares very unfavorably to both STB and creation and really illustrates the impact of the narrowing net interest margin. So yeah, subtracting these operating costs and cost of risk from the operating income gives us the profit before tax of £12.6 million, which is down 78.5% from the £58.6 million generated in FY 2022. And after tax, the net profit comes to just £10.2 million. Review scores on Trustpilot are very good, with a 4.6 out of 5 rating from 3,756 reviews, which stands up well against STB and creation. In conclusion, while Novuna has built up a large loan book and retail partner base, its competitive standing is weakened by its inability to raise funds through retail deposits. With interest rates around their current level, this is likely to restrict the company's growth and possibly result in them losing market share to competitors. Right. So now we move on to Klarna. I'm sure most people will have heard of Klarna at this point. It is the first of several companies we'll discuss that have taken a consumer-centric approach by building an app with a marketplace of stores offering buy now, pay later credit with Klarna. Once a store has been selected, users are directed to the store's website where they can shop for the product they want and complete their purchase conventionally. As well as being a driver for retailers to add Klarna as a payment option, having such a marketplace creates an opportunity for generating advertising revenue from retailers who want their stores to have more prominent placement within the app. Klarna is integrated into the checkout, much like the other point-of-sale credit providers, and I will stress that downloading the app is not a prerequisite for making a credit application. You can provide all your details during the checkout process in the same way you can with V12, and the app is entirely optional for managing your loan balance afterwards. It does, however, have some convenient features like order tracking and returns that can make it worth installing even if you don't intend to use the marketplace. The main credit product Klarna offers is pay in 3 interest-free credit, where 1/3 of the cost is paid up front, followed by 2 further payments at 30-day intervals. Additionally, it offers 30 days deferred payment interest-free and 3 to 36 months interest-bearing credit. The 30 days deferred payment product also ties into their card, which is available physically or virtually and works much the same way as a regular credit card, with the slight difference that the user gets 30 days interest-free credit from the date of each individual purchase rather than on a rolling monthly basis. The card is also accepted anywhere you can use Visa, meaning users aren't restricted to those retailers that have integrated Klarna into their checkout. It is, of course, just a 30-day deferred payment, making it only really suitable for smaller purchases. The company's UK loan book, net of impairment allowance, was £863.1 million at 31st of December 2023. Given the short duration of most of the loans provided, I would expect the new business volume for the year to have been upwards of 6x this figure, which aligns roughly with net operating income of £193.5 million for the UK. I don't have a specific figure for credit losses attributable to loans issued in the UK, but I can tell you they were £296.2 million globally against global net operating income of £1,515.6 million. This is a significant improvement on the prior year, where global credit losses and net operating income were £420.1 million and £1,227.2 million, respectively. As you might expect for a venture capital backed firm investing for growth, it made an operating loss after subtracting general administrative expenses, a good chunk of which will be attributable to marketing. Up until now, most of V12's growth has been driven by business-to-business sales teams, and it hasn't had to spend much on its marketing. Sorry, much at all on its marketing. If management intends to shift towards a more consumer-centric approach, as seems to be the case with App2Go, they'll need to factor in the marketing spend required to compete with the likes of Klarna and its deep-pocketed backers. Something that marks Klarna out from some of the other firms in the space is the fact it's able to raise retail deposits outside the UK. This there shouldn't be emphasis on the outside the UK, that's in brackets. But yeah, it's able to raise retail deposits, which is what marks it out from some of the other buy now, pay later firms. This has allowed the company to remain competitive and continue growing its loan book as interest rates have risen. Reviews on Trustpilot are very good, with a 4.1 out of 5 star rating from 311 global reviews. And since a big part of the product is Klarna's app, I should also mention that it has a 4.9 out of 5 star rating from 173.7 thousand reviews on the Apple App Store and 4.5 out of 5 star rating from 591,000 reviews in the Google Play Store and more than 10 million downloads. Obviously, that's global there. In conclusion, I'd say that Klarna will be a formidable competitor to as STB begins targeting consumers with its new product offerings rather than retailers. It has already become a well-known brand with consumers and can compete on a funding level with its retail deposit base and venture capital backing. So next we move on to have a look at Clearpay. So Clearpay has several similarities to Klarna, including an app-based marketplace replete with supported retailers and a digital card for in-store purchases. However, the card is restricted to retailers that support Clearpay, unlike Klarna's that is accepted anywhere you can use Visa. In terms of credit products, it has just one, interest-free credit, where 25% is paid up front, followed by 3 further payments spread equally over 6 weeks. Reviews of Clearpay on Trustpilot are very favorable, with a 4.8 out of 5 star rating from 36,886 reviews. The app has a rating of 4.9 out of 5 stars from 40.5 thousand reviews on Google Play and more than 1 million downloads. And the Apple App Store rating is 4.9 out of 5 stars from 70.8 thousand reviews. Clearpay was acquired for £10 million in 2018 by Australian buy now pay later firm AppToPay, which was then itself acquired by Block, the company that also owns, I think it's called Square, is it? Anyway, yeah, Block. It's the Jack something or other, the guy who used to own Twitter. Anyway, can't remember his name. So which was then itself acquired by Block in 2022 for $13.8 billion. So I think Clearpay was almost entirely UK focused. That should be the emphasis. It was acquired then by an Australian company called AppToPay, and then Block acquired AppToPay for an extraordinary large amount of money. And at the time that they bought it for $13.8 billion, the global loan book for AppToPay was $1.2 billion. So absolutely massive multiple there. Despite these changes of ownership, Clearpay Finance Limited still files its accounts with Companies House giving us some insights into the financials. And just a quick note, I believe the year end changed after Block acquired the company, so we have some weird comparisons between 18-month and 12-month periods. Just bear that in mind when you see the figures. So the company's net loan book at 31st of December 2022 stood at £121.9 million after subtracting provisions against default of £15.2 million. The figure was 68.6 million pounds at the 30th of June 2021, with provisions of 7.6 million pounds. So lending has grown rapidly from a low base. Operating income for the 18 months ending 31st of December 2022 was 95.3 million pounds, while the cost of risk was 43.9 million pounds, bringing the risk-adjusted income down to 51.5 million pounds. Operating costs amounted to 56.3 million pounds, resulting in a cost-income ratio of 59.1%. Not particularly great. And subtracting the operating costs and from the risk-adjusted income gives us an operating loss of 4.9 million pounds. After applying an income tax credit, the net loss comes to 2.3 million pounds. As of the 31st of December 2022, Clearpay was reliant on wholesale funding to finance its lending, with an interest rate of SONIA plus 2.95%. Given that SONIA is currently around 5.19%, might have come down a little bit now with rates being slashed, but at that time, this implies a cost of circa 9.14%, which I would expect to have severely limited its growth since then, assuming Block hasn't provided some alternative financing. The level of threat to STB really depends on how much Block is willing and able to support Clearpay with funding. Given the fact its product set has not expanded since the acquisition, the answer could be not much. Yeah, I mean, the amount Block paid was absolutely shocking. I think it was it made quite a few news things because I think they've I think the actual amount of goodwill in there was something like $11 billion. It was absolutely crazy. And I have a feeling that they pretty much wrote it down always like a year later or something. So an absolutely massive uh, misallocation of capital, of shareholders' capital there for Block shareholders. Especially when you consider how much STB paid for V12. It was really not much more than than the actual loan book at the time. When you combine the debt they paid off and the payment for equity and so on. But in this case, this is about more than 10 times the loan book. And yeah, as you can see, they have not been lending very well. There's been a lot of defaults. They're very high cost of risk there. I didn't calculate as a percentage, but if their operating income was 95.3 million and the cost of risk was 43.9, it's getting close to like a 50% loss on there, which yeah, is not great when you compare that to the sort of some of the other lenders that are doing less than 1% cost of risk on their lending. But obviously it's different markets, low credit quality end of the market really that these guys are operating in. So next we move on to Zilch, which is pretty well a copy and paste Clearpay. It offers the same pay over 6 weeks product, though with the added twist that it provides cash back to customers if they pay immediately. And it has an app-based marketplace along with a digital card for in-store purchases. The company has stated its intention to add a slightly longer pay in 3 product that would differentiate it from Clearpay and bring it more in line with Klarna. There isn't a published timeline for it yet. Trustpilot reviews for Zilch are very favorable, with a 4.6 out of 5 star rating from 55,713 reviews. The app has a 4.2 out of 5 star rating from 8.97 thousand reviews on Google Play and over 1 million downloads, and a 4.2 out of 5 star rating from 2.8 thousand reviews on the Apple App Store. So yeah, I mean, with a lot of these with a lot of these players, I think part of they've got these nice to use apps, but part of it is going to be how readily they will provide the financing. It seems like there's a pretty high bar for getting rejected, or conversely, a pretty low bar for getting accepted, which probably shows you the contrast with something like the Barclays part of the finance, which they're providing lending on similar kind of products to what these companies are offering, but they're obviously being a lot more stringent and strict with their lending criteria, which then help to really tank their review score. So yeah, good review scores with these, but it's not, the actual credit losses are reflecting how that, the ease with which they're lending to some of these people, some of their customers. So the net loan book as at 31st of March 2023 was £30.8 million after subtracting a credit loss allowance of £6.4 million. This is down significantly from the prior year, where the net loan book was £38.7 million after subtracting a credit loss allowance of £13.8 million, implying a significant tightening of lending criteria. Operating income for the year ended 31st of March 2023 was £13.5 million, while the cost of risk was £13.7 million, resulting in a risk-adjusted income of negative £0.2 million. So, so they actually managed to lose more money than they lent out, than they earned in income in the year, just from the defaults. Operating costs for the year were £72.3 million, resulting in a cost-to-income ratio of 536%. Generally, scale brings down the cost-income ratio, but as Zilch isn't currently profitable on a risk-adjusted basis, there are obviously some serious improvements to lending quality required before scale will improve things. Subtracting the operating costs and adding £0.4 million in other income gives the loss before tax of £72.1 million. Adding a tax credit brings the net loss to £71.8 million. Zilch's management also gives some color on the gross merchandise value, new business, for FY23. In the year, the company achieved a GMV of £767 million, of which 82% were credit transactions, i.e. the customer didn't opt for immediate payment. This really illustrates the short duration of the loans and also the seasonal variation in lending volumes. Since the GMV is more than 20 times the size of the loan book at the year end. The company is currently funded largely by equity totaling £64.7 million, but intends to fund its loan book with a combined £125 million lending facility provided by Goldman Sachs Asset Management, which is also a shareholder, carrying a floating rate of interest. As at the 31st of March 2023, Zilch had drawn down £27.9 million on the facility. So, as with the other companies mentioned, a reliance on wholesale funding is going to make profitable growth challenging, to say the least. I don't know what the hell Goldman Sachs Asset Management is doing in this one. Um, anyway, just shows you some of these big investment banks and stuff like that are actually not particularly, and venture capital and the rest of it. It's this same old story, isn't it? Across all the different uh, sectors that draw people's interest and money. Yeah. So next we have Laybuy. So another very similar one. So Laybuy is a New Zealand-based company that has recently begun expanding into the UK. It again has a very similar model to Zilch and Clearpay, offering interest-free credit over 6 weeks, an app-based marketplace, and a virtual card for in-store purchases. It seems to be struggling to deliver, however, as evidenced by its 2.5 out of 5 star rating from 9,971 reviews on Trustpilot and 2.1 out of 5 star rating from 10.6 thousand reviews on Google Play, with over 1 million downloads, though slightly redeemed by a 4.7 out of 5 star rating from 6.8 thousand reviews on the Apple App Store. So, sounds like not really been bothering that much with their Google Play app, but done a fairly decent job with the Apple, with the iOS app. At the 31st of March 2022, the company had a global net loan book of 33.3 million New Zealand dollars after subtracting impairment provisions of 7.9 million New Zealand dollars. While there isn't an explicit segmental breakdown, we do know that 20.2 million New Zealand dollars was held in GBP, implying it was attributable to the UK business. This also aligns with the fact that 61.1% of the company's income came from the UK before costs. I don't think it's necessary to dig too much further into Laybuy's financials, other than to present you with the following quote from the independent audit report. We draw attention to note 3D in the consolidated financial statements, which indicates the group incurred a loss after tax of $51,583,000 and a net cash outflow from operating activities of $51,967,000 during the year ended 31st of March 2022. And as of that date, the group's net assets were 26 million and 33,000. As stated in note 3D, these events or conditions, along with other matters set forth in note 3D, indicate that a material uncertainty exists that may cast significant doubt on the group's ability to continue as a going concern. At the time of filing the FY22 annual report, the company was looking to raise new capital, and in the time since, it has delisted from the Australian Stock Exchange, ASX, 2 years after its IPO. I therefore wouldn't consider Laybuy to be a concern for STB at present. And finally, I've looked at PayPal. So the UK consumer credit makes up a very small part of the overall PayPal business, and so we can't get much info from its group financials. What I can say, though, is that the company offloaded most of its European loan book, around $44 billion, to KKR in 2023, KKR being a private equity and credit business, giving you some idea of its scale. The products offered in the UK are predominantly interest-free credit variants, pay in 3 for lower value purchases, and longer term comparable to V12 for higher value purchases. And as we saw on a screenshot earlier, that it was one of the options alongside V12 for the like golfing site. Scottsdale Golf, I think it was. Yeah. Trustpilot reviews for the company aren't good. With the UK website having a 1.3 out of 5-star rating from 5,371 reviews, and the US website also having a 1.3 out of 5-star rating from 29,298 reviews. However, the reviews for the PayPal app are much better, with a 4.4 out of 5-star rating from 3.2 million reviews and 100 million plus downloads on Google Play, and a 4.8 out of 5-star rating from 1.1 million reviews on the Apple App Store. And I think somebody pointed out to me there's probably quite likely that uh, Trustpilot reviews and stuff like that are tied to eBay or something like that, where PayPal was the uh, finance provider, um, and just payment provider, I think, generally for eBay for quite a long time. I'm not sure quite what the situation is now, but and I think at one point it was actually owned by eBay as well. Or they had at least had a big stake. So anyway, yeah, there's maybe some joining the two there. My experience with PayPal has always been good. I've never really used the app, but I do use it quite a lot online for purchases and things like that. It's just convenient to be able to log in rather than have to fill out your payment details every time. Um, I have used their credit product a few times, the Pay in 3. It's quite a convenient application process and so on. Quite comparable to the other ones like Klarna, which I've tried once before as well, the Pay in 3, and obviously V12 and stuff like that as well for the longer ones, longer term contracts. But yeah, so yeah, just my final points here. So on PayPal, so PayPal is definitely a serious competitor for STB with both brand recognition and significant financial clout, though it's not clear how profitable such lending is for the company in the current high interest rate environment. I don't believe it has a UK banking license and will therefore be reliant on wholesale funding, with the KKR deal perhaps suggesting it was getting prohibitively expensive to service. So yeah, sounds like they're offloading their funding. So this was an example of one of those I mentioned earlier. Um, with it basically just coming to them, they're providing the interface with the customers to issue the credit and so on, and then actually just taking a fee on that, and the actual financing being done by someone else. In this case, they've handed it off to KKR. I don't know whether that's going to be an ongoing thing for all the rest of the new lending they do, but it certainly was the case for that 44 billion that was sitting on their books. Um, so yeah, I would say out of these, ones I'd be most concerned about, so obviously PayPal, Klarna, possibly Clearpay a little bit, but mainly those two are the shorter term credit ones would be the biggest competitors. I think creation was very formidable. That's definitely one. It's going to be on the longer term stuff. It's going to be a big competitor for getting some of the big retailer deals and so on. Novuna obviously has had a good record of building out these relationships with retailers, but it's struggling on the funding side. So maybe if interest rates, there's a time now where V12 can start to capture market share from them as they can't continue growing their book, and maybe even have to shrink it a bit. Um, well, interest rates are high, but if interest rates were to fall and it starts becoming more profitable for them to lend again, then yeah, it sounds like they've obviously got a good brand and a good reputation with retailers and so on. Because a lot of this, so a lot of these first ones I was looking at here, a lot of it comes down to the business to business relationships. It's not really, even though V12 has a good relationship with customers, and that's a selling point for the apps it's on, provides a good selling point for retailers. The actual sales, the deals are done through business to business relationships directly with the retailers. So it's quite a different kind of sales process. Whereas things like, well, I guess to get them integrated into storefronts and stuff like that, it is. But obviously, a lot of the Klarna model is they get a big consumer base, and then that's then their pitch to retailers. They have these, we have all these consumers we can bring to your platform, and they have their marketplace built into the app and so on. So they're effectively able to market retailers and stuff like that through their app with all the and deals and so on that retailers want to offer. And I think collect they collect some revenue from uh, product placement on their app, their sort of marketplace within the app. So yeah, somewhat different business model there. But yeah, those I would say are the key competitors. But V12 is certainly holding its own, and as we've seen, is growing market share. So yeah, that pretty much that sums up the retail finance business, which, as I said, is possible. I think the maybe joint largest with real estate finance in terms of the loan book, but in terms of its contribution to the group's overall operating profit, I think it is the largest now because it's doing higher margins than the real estate finance business. But yeah, so that's going to wrap up this video today. So I'll look on in the next video. I'll go on to have a look at retail finance. Sorry, not retail, vehicle finance. Possibly might be able to squeeze in another one. See how we go with the vehicle finance. Yeah, I'll probably do it as a shorter one and do one segment each. So we'll do next video. We'll have a look at vehicle finance. As you can see, go over do it again, some competitor analysis. Then we'll have a look at real estate finance, go through different products offered, etc. Some example deals they've done, loan books, interest margins, again, some competitor analysis, and finally commercial finance. Or go through a similar format. And then yeah, well then I think we'll probably be able to bundle the rest of the thing into maybe a final episode. So we'll look at the savings products, which is obviously where they get the deposits from, and then go through the whole group's financials in detail. So you can go into a lot more detail on those, each section of the accounts, each key financial statement. Yeah, breaking down the loan book, impairments, etc. And then yeah, this might end up being it's going to have to be a standalone on its own. Look at salaries, the management compensation, etc., investment outlook, and so on. So yeah, if you're interested, you can read what I've actually given you today, which is the retail finance segment. If you're interested to read more, you can either pay for 1 month, which is £15, or I've basically got it set up so I want it to be a minimum payment for. So this is 16,000 words. It took me about 6 months to write this, to do all the research and write this report, including attending the AGM, speaking to management there and outside of it. And yeah, going off and digging through the filings of all those different competitors I was just talking about there. So quite a number of them being private companies, so having to try and track down where they've got some accounts still publicly available in the UK. Like I said, with the company's house, they can kind of give you a cut down accounts if the company's above a certain if above a certain size in terms of their revenue and stuff like that, they have to publish at least the three well, at least the earnings, an income statement and a balance sheet and so on. So kind of get some info out of that. They always try and make it as little as possible. And then in cases where there's a parent company, stuff like that as well, digging through, which is a public company, as we saw with like Creation with BNP Paribas or Barclays, personal finance, etc. I can try and pull some information out of there where they mention the financials of some of their subsidiaries, and just general picture for that segment of the business. So yeah, a lot of work got into it. So I kind of, with that in mind, to read the full thing, I set the threshold at about £15. But I think what's a much more advisable thing to do is if you pay for an annual subscription, it's just £30, which works out to be £2.50 a month. So really minimal, and like ongoing sort of cost for that. And with that, you get, in addition to these research reports, which, like I say, it takes about 6 months to write, so there's probably going to be a couple a year. Hence the £30, and then or £15 a month for one, effectively. If you just want to read this, pay £15, county subscription afterwards. But ideally, it'd be nice to have you on board for future ones, and to give that ongoing support with. I also provide these company updates are fully free. So if you're not interested in, if you want it, you just, I mean, you get enough of a pitch, I would say, from this. You've got the executive summary, you've kind of got my investment pitch. You haven't got the full investment outlook and all the detailed analysis, but you get a bit of a flavor for it, and you get the executive summary. If you're just interested to see that and go and do your own work, absolutely fine to get that for free. I'd encourage you to subscribe to the free newsletter, and then you'll get these straight in your inbox. And then you'll also get for free company updates. So this is another episode I'll do at the end after I've finished off going through the research report. You get these company updates come in. So whenever they do, normally I do it with the interim results and the so you'd expect it at least twice a year, interim results and then the full year results. So yeah, they've got this one for the interim results that I did in September. And then when they do their full year results next year, I'll do another update. So yeah, you expect a couple of these a year for each company. And as you can see, I do this for all my different holdings as they release their results with a different year end and so on. So this was a long one on Tinybuild. I think it was ended up being about 3,000 words with a breakdown of and there's an episode. I've got an episode going through this as well, of a video going through this as well. If you want to give that a look, I'll put a link at the end of this video, going through their half year results and then going through the upcoming game releases and stuff like that. And then another thing you get if you pay is I send out these portfolio changes. So whenever I make a purchase or a sale of shares within my own portfolio, I just send it out, disclose it all fully to you. So an example, I've done quite nicely with Viva, decided to sell 200 shares of Aviva and reallocate them into a purchase of some more Warner Bros. Discovery shares, which were trading at really languishing down at $6.75 at the time of purchase. They're now gone back up to closer to $8, but yeah, it looked particularly attractive at that point given all the things that are going on. So I'll give you a bit of a quick update with each one as to my rationale, why I think I'm making that a particular move. Sometimes it's just, I continue to see this as attractive, I'm going to keep adding to it. Yeah, and you can see I've done quite a few purchases of Secure Trust Bank, building up that position. It's now actually my largest position in my portfolio currently. So yeah, just to give a flavor of that. Yeah, and I think I will also, with the portfolio updates, I'll probably also start putting out a kind of yearly review of the portfolio and what the performance has been for the holdings, um, and yeah, how it's moved around. Just a quick breakdown of each one. So I'm planning to do that for the first time the end of this year as well. So that'll be something else you'd get in your inbox. Just a kind of imagining it was a fund or something like that. Just a review of my overall portfolios and the underlying companies, how they've performed in the last year. Yeah, that'll be something I do annually. So I'll do it at the end of this year. So probably end up being January or something. You get a review of the last year. So that'll be something else to look out for you in your inbox. If you choose to go for the pay subscription. But anyway, I think that's enough pitching that. So yeah, again, I will continue on next time with the vehicle finance segment. So yeah, I will see you then. Thanks for watching, and yeah, please like, subscribe this video, and comment anything any thoughts you have on Securitas Bank and any of the other companies I've mentioned.